Financial's been a standout this year. The group pushing to record highs. The macro backdrop, of course, has been favorable, continues to evolve, though. Joining us now, RBC Capital Markets co-head financials research, Gerard Cassidy. Gerard, you've been bullish all year. It's been the right call. What are you thinking heading into next year?
David, thank you, and thank you for having me on the program. The outlook remains real positive. The trends that we saw develop in 2025 are expected to continue into 2026, especially when you think about the yield curve, David. The steepening of the curve is very positive for banks. And if the Fed cuts another 25 or 50 basis points between now and June, let's call it, that's going to be added fuel for the bank stocks, we think, particularly the regional stocks in 2026.
You know, the regulatory side can be a bit harder to measure, but certainly it does seem as though there is more room, so to speak. Wells Fargo, obviously, has been a beneficiary in terms of the asset cap coming off. But more generally speaking, how do you sort of define the regulatory environment, and how favorable is it right now for the banks?
David, you really put your thumb on a critical issue for the banks, which is the regulatory environment has changed dramatically from the prior administration to the current set of regulators. We've never seen it move this so quickly. And the biggest change is yet to come, which is the Basel III endgame, which is a big proposal on the capital levels for all the largest banks. But when you look at the proposals that the regulators have brought forth already, they are very constructive and supportive of the banking industry. And if the Basel III endgame proposal comes in as supportive as what we've seen so far for the other regulations that they've put forth, then you should see profitability for the group to grow, which is very positive for valuations.
What does that mean for the regionals in particular, or the super regionals, which haven't performed as well as some of the bulge bracket or money market groups like the Citigroups and Goldman Sachs, which have done better than regionals? Do they have their catch up in 26?
Sarah, good point. And the money centers and the investment banks have done extraordinarily well this year due to the strength of the capital markets, particularly the mergers and acquisitions. The advisory business has been remarkably strong. I think this year might go down as the second best year behind 2021. And so the regionals, we think, will catch up to the big banks in 2026 because of what I referenced a moment ago, which is the steepening of the yield curve. That will lead to better spreads, and the regional banks generate a greater percentage of revenue from net interest income, which should give them a leg up. Now, all the banks will benefit, but maybe the regionals more. The second, loan growth. I think what you're going to find in 2026 is the banks now will get back to lending more aggressively, and you could see loan growth surprise to the upside, particularly on C&I, commercial and industrial loans, as well as commercial real estate. Remember, the banks have been shrinking the commercial real estate portfolios. We think they're going to inflect in 2026.